Chapter 12. Cognitive Biases. The investor's chief problem, and even his worst enemy, is likely to be himself. Benjamin Graham. The human mind is a complicated place. It plays tricks with our perception of reality. A considerable part of our conceived reality is made up. Our brain fills many gaps, and it is a good thing when we negotiate with the physical world. However, it also fills a lot of holes in our emotional reality. These made-up beliefs are called cognitive biases. An investor must recognize and understand the presence and impacts of these biases to minimize the negative repercussions. It is impossible to eliminate these biases, but they can be managed, or a better understanding can lead to a positive outcome. Investing isn't about beating others at their game. It's about controlling yourself at your own game. Jason Zweig. All of us are guilty of most of these cognitive biases. We are emotional beings, and our actions are contaminated with our emotions. In the following few pages, we will briefly discuss common cognitive biases. This is, by no means, a complete list of cognitive biases. But in my opinion, these are the most important for an investor. Anchoring bias. Anchoring bias occurs when an investor relies too much on preconceived ideas or information. It doesn't matter how reliable that idea or story is. However, once we anchor into it, it is challenging for our mind to disregard previous information and rely on new information. For example, once we have read a detailed report about a company, we consider it the most reliable information regardless of its actual reliability. When you develop your opinions on the basis of weak evidence, you will have difficulty interpreting subsequent information that contradicts these opinions, even if this new information is obviously more accurate. Nassim Taleb. Another example is our entry point in an investment. Our purchase price is no more significant than any other price point, but we unconsciously give it much more significance. Likewise, all-time highs and all-time lows get way more importance than they deserve. Neglect of a probability. All investors are guilty of neglecting probabilities. When we decide to enter into a risky investment, our mind plays with us, and we become blind to the likelihood of an adverse outcome, at least partially. At the moment of pulling the trigger, our mind only sees the possibility of a great return. It neglects the unfavorable possibilities. The outcome of an investment decision is always random in the short run. The possibility of a head in a coin toss is random in a flip or two. However, over the long run, outcomes are governed by probabilities. The next tick of stock price is random, but stock prices are supposed to go up in the long run. No matter how sophisticated our choices, how good we are at dominating the odds, randomness will have the last word. Nassim Taleb. Bandwagon effect. Bandwagon bias is the tendency to do something because everybody is doing it. We see this effect at its peak in all market bubbles. People bought the dot-com stocks because everybody was buying those. Cryptocurrencies, marijuana stocks, tulips, railroad stocks, and many others were purchased for the same reason. Most people get interested in stocks when everyone else is. The time to get interested is when no one else is. You can't buy what is popular and do well. Warren Buffett. Hindsight bias. Hindsight bias is the tendency to believe that an investment could have been made in the past with certainty. People think by looking backward in charts that everything is so crystal clear, and they should have pressed the button. However, in reality, the past was no more apparent than the present. Hindsight bias is the reason people think and talk about fantasy investments. Technical analysts suffer from this bias more. Take any technical indicator and apply it to any stock that you like. You will find multiple valid signals. Millions could have been made. Past events have already occurred and are known. It is easy to invest when you know for a certainty that stock will go up. But the future is unknown and uncertain. That's why it is not easy or comfortable. Oversimplification. Capital markets and behaviors of its participants are complex and are subject to many variables, often working in different directions. However, it is a common tendency among investors that they blame only one variable as the single cause of a significant market move. Yet, in reality, at any given time, multiple reasons are impacting the prevailing prices. It is not easy or even possible for a person or group of individuals to analyze all moving pieces correctly and calculate their impacts on prices, so everybody takes the easy way out. We pick one reason that we believe is the most important and blame all the price action on that one reason. This behavior is called oversimplification bias. When we think that a change in prices is because of one single reason, we are also convinced that prices will turn in the opposite direction when this most crucial reason is removed. It's not supposed to be easy. Anyone who finds it easy is stupid. Charlie Munger. Loss aversion. We all are guilty of loss aversion bias. We hold onto our investments, often irrationally waiting for a turnaround. We fear that the day we sell, our investment will turn around. You bought a stock for a certain reason. Say, for example, sales were going up significantly year after year, and now that reason is no longer valid. Technology has changed, or another competitor has come up with a better product. Now the reason why you bought the stock in the first place is no longer valid. You will be better off selling that stock and moving your capital somewhere else. An investor in BlackBerry or Nokia should have sold these stocks once it was clear that iPhone is the future. There are no points for loyalty. You bought BlackBerry for a reason, and this reason is no longer there. It doesn't make sense to keep BlackBerry waiting to turn around and introduce a better product than iPhone. If it does, repurchase it. Otherwise, your capital is better served in Apple stock. Irrationally keeping a stock is equivalent to buying the same stock at this price. Endowment effect. Endowment bias is somewhat related to loss aversion. It is the tendency to believe that our investment portfolio is better than anybody else's. We tend to be emotionally attached to our choices in life. For example, you and your cousin both went on vacations to 2 different spots for a couple of weeks. Both of you had fun, and once you returned, both of you believe that your vacation spot is better than the other. In reality, both places were excellent and worth going to. However, as you experienced only one location, in your mind, your spot is better. The same thing happens when we choose our capital allocation. In our minds, the stock that we picked was better than any other shares that we do not hold. That is the reason we bought it. The reality is that we investigated only a few stocks and picked the one that we believe is the best among the few stocks that we examined. It doesn't mean that the share we chose is the best among all the shares, or even among the few we analyzed. Our analysis could be incorrect. Once we have allocated our capital into the stock of our liking, we start analyzing it in even more detail. We read more about it, and finally, we start believing in it. Our desire to be right forces us not to let go of the stock, even if our rational analysis calls for an immediate sell. Information bias. Information bias is the tendency to rely on delayed, incomplete, or inaccurate information. A retail investor is more susceptible to information bias than an institutional investor. Generally, an institutional investor has access to prompt, complete and accurate information. They have access to a more extensive data set and better tools to analyze the data. However, it doesn't mean that a conclusion taken by an institutional investor is always better than all retail investors. Having access to better information is not synonymous with better decisions. Confirmation bias. Confirmation bias is the tendency to listen only to sources that confirm our preconceived perceptions. We naturally lean towards people who agree with us. It is in our DNA. We hang out with like-minded people. We talk to colleagues who share our life interests. And we listen to financial gurus who tend to align with our investment ideology. We make investment choices for a reason, because in our minds, those are the best choices to be made. Any other decision is inferior to our decision. Unconsciously, we buy only those books that confirm our investment ideology, and we read only articles aligned to our methods. We listen only to those people who speak our financial language. This bias blinds us to the other side of reality. More often than not, we enter into a make-believe reality where our opinion is the only correct opinion. The most contrarian thing of all is not to oppose the crowd, but to think for yourself. Peter Thiel. Country bias. Country bias is the tendency of investors to invest disproportionately in companies of their own country. A Canadian investor tends to invest heavily in Canadian companies, and a U.S. investor tends to invest in U.S. companies, and so on. This phenomenon has nothing to do with patriotism. It is a cognitive bias that compels us to invest in familiar companies. Nowadays, a global investment portfolio is as easy and possible as an investment in your own country of origin. A willing investor is no longer confined to political boundaries. Despite this freedom of investment, it is a global tendency that investors disproportionately invest in local companies, sometimes exclusively. Recency bias. Recency bias is the tendency to give more importance to recent events than historical averages. If a stock is rising for some time, people tend to forget its volatile history or vice versa. This emotional bias forces people to buy high and sell low because we give disproportionate weight to most recent events consciously or unconsciously. Availability heuristic bias. Availability heuristic bias is investors' tendency to rely much more heavily on information that they can recall from their memory immediately. It is a bit different from recency bias, as under availability heuristic biases, memorable events, either painful or delightful, have much more weight in decision-making than non-memorable events. In other words, any event that can be recalled easier than others has more weight in decision-making. The 1929 stock market crash haunted investors for generations, although later years had decent stock market gains despite a Great Depression and a World War. Historical stock market gains from 1982 to the mid-90s led to the euphoria of the late 90s. Ostrich bias. Ostrich bias is named after a behavior associated with ostriches when they bury their head into the sand, believing they are safe from oncoming threats, although the whole body is exposed. Investors tend to demonstrate this cognitive behavior when they avoid any opinion and any unpleasant voice. Investors don't want to hear the other side of the story. They don't realize that when they bought a stock, another person on the other side of the transaction had an opposite opinion about the same stock. When the reality occurs, they tend to hide within their arguments and disregard the opposing views. They forcefully avoid articles, ideas, books, whatsoever that are not in complete agreement with their viewpoint. Outcome bias. Outcome bias is the tendency to rely on the outcome of an investment decision rather than the actual decision process. If the outcome is good, then the decision was good, and if the outcome is bad, then the decision was bad. In reality, a perfectly wise decision may end up in a loss, and a total dumb decision may end up in huge gains. The outcome bias compels investors to jump from one good strategy to another because of one bad outcome. Even worse, when investors try to convert a reasonably good strategy into a perfect one because of one or two bad outcomes. On the other side of the coin, investors heavily rely on a bad strategy and risk a considerable portion of their capital into a risky position because of a few good outcomes. The correctness of a decision can't be judged from the outcome. Howard Marks. Overconfidence. Overconfidence bias is the tendency to overestimate our knowledge and skills. We think that our knowledge and skills are above average, and so are our investments. However, it is mathematically impossible that a majority of people will be above average. Our knowledge, skills, and results of our investment endeavor must fall into a bell-shaped random distribution, where most people would be within, plus or minus, one standard deviation away from the mean. Few people will be 2 standard deviations, and even fewer people will be 3 standard deviations away from the average. Overconfidence is a very serious problem. If you don't think it affects you, that's probably because you're overconfident. Carl Richards. Scores of surveys have found that most investors are confident about their investment choices, even when they are not confident about the overall market. In other words, the majority of investors believe that they will be able to beat the market. The reality of investment results is precisely the opposite. Only a fraction of a percent of investors can beat the market consistently. This tendency of overconfidence and poor outcomes is not confined to only retail investors. Institutional investors suffer from overconfidence equally, if not more, and their investment results are not superior either. Survivorship bias. Survivorship bias is the tendency to give disproportionate weight to the most successful, or at least to the ones who manage to survive over a long period of time. During the dot-com bubble, thousands of companies were listed and achieved billions of dollars of market capitalization. However, we only know Google and Amazon and fantasize about the what-ifs. What if we had invested in these two companies at the time of IPO with $10,000 each? Nobody talks about AltaVista or Boo.com. All analysis and surveys of past performance are contaminated with the survivorship bias. Suppose we want to analyze the performance of companies within 10 years of their IPOs. All of those companies which couldn't last 10 years will be automatically out of our data. We can only analyze companies that survive 10 years or more, so the analysis is flawed from the beginning. Perception bias. Perception bias is the tendency to perceive facts through the filters of our preconceived ideas and past experiences. Identical information can lead to opposite conclusions based on relative perceptions of its receivers. Humans are not machines. They analyze information through the lenses of their experience, knowledge, and cognitive biases. All of it makes their perception their unique viewpoint. If you are wearing yellow goggles, every blue thing will appear green to you. It is your perception, and it is your reality. All of your future actions will be under your perception. That's what makes the investment business exciting and our world worth living in. Restraint bias. Restraint bias is the tendency to overestimate our ability to overcome investment biases or control impulse decision-making. We all think that we can control our behaviors, but in reality, very few people can detach themselves from their emotions in a meaningful way. We all know that a significant part of investment success is the inner game. Psychology plays an essential role in the business of buying risk assets. It's not a secret that emotions can destroy our investment account in a short amount of time. There are countless books available on this topic. It doesn't matter how many books you have read. If you think that you can control all emotions all the time, you are probably suffering from restraint bias. Chapter takeaways. A considerable part of our emotional realities is often made up by our minds. As humans and investors, our actions are not always rational, but somewhat contaminated by our own emotional and cognitive biases. Don't try to kill your emotions. You won't succeed. Instead, try to be aware of being human.